Before Silicon Valley Bank became that name, the one synonymous with a banking crisis, it was the absolute darling of the market. I mean, this wasn't just some run-of-the-mill bank. It was an icon, a growth machine that everyone believed had the magic formula. But as we all found out, perfection often comes with a very, very steep price. To really get the SVB story, you've got to start right here. Just look at this. During that pandemic-era frenzy in 2020 and 2021, SVB wasn't just doing well, it was in a completely different league. While other regional banks were doing just fine, SVB's stock was on an absolute rocket ship. To any investor looking at this chart, it was a no-brainer. This was the bank of the future. And the story they were selling? Oh, it was irresistible. They weren't just a bank, right? They were the financial heartbeat of innovation, the partner to every venture capitalist and every startup dreaming up the next big thing. This wasn't just a business plan, it was a powerful and really convincing myth. But here's the thing about a great story. It can make you blind. It can make you completely ignore the hard facts. And in SVB's case, the facts, hidden in plain sight, right there in their own financial documents, were screaming that something was deeply wrong. So let's do what the market didn't. Let's pull back the curtain and look at the red flags that pretty much everyone chose to ignore. Okay, red flag number one. And honestly, this one's the most obvious because it was hiding in plain sight, right there in the stock price itself, the bank's own valuation. This is where the story of perfection starts to completely break away from reality. 3.5. Just let that number sink in for a second, because it's the key to this whole mess. At its absolute peak, the market was willing to pay $3.50 for every $1 of SVB's actual tangible stuff. And to understand just how wild that is, we need to talk for a second about how banks are supposed to be valued. So this brings us to a kind of nerdy but super important metric called price to tangible book value. Now, stick with me here. It's simpler than it sounds. A bank's business is its assets, its loans, its securities. So a valuation of 1 times book is considered fair. You're paying $1 to get $1 worth of actual assets. Makes sense, right? So SVB wasn't just being priced for a little bit of success. No. At 3.5 times, it was being priced for absolute, flawless perfection. The kind of perfection that leaves zero room for error. No room for interest rates to change. No room for anything to go wrong. This wasn't just optimism anymore. It was a bubble, plain and simple. So if the valuation itself was basically screaming overpriced, wait till you see what the insiders were doing. The people who ran the bank, the ones who knew it better than anyone. Their actions were telling a very, very different story with their own money. I mean, it's a pretty simple question, isn't it? If you truly believe your company is the next big thing, if you think it's on a path to glory, what do you do with your stock? You hold on for dear life, or you buy more. You bet on yourself. So, did SVB's top brass bet on themselves? Yeah, the numbers here are just, wow, unbelievable. We're talking nearly 900,000 shares sold by insiders in the run-up to the collapse. And the number of shares they bought? Fewer than 8,000. Do the math on that. That is a sell-to-buy ratio of over 100 to 1. Think about that. While the public story was all about growth, their private actions were all about cashing out. Okay, so the sky-high price tag and the insiders heading for the exits. Those were the flashing warning lights on the dashboard, but the problems ran way deeper. If you actually popped the hood and looked at the engine of the bank, well, it had been sputtering for a long, long time. All right, this chart shows something called net interest margin, or NIM. All you really need to know is that this is the bank's core profit engine. It's the difference between what it earns on loans and what it pays out on deposits. And as you can see, SVB's engine was just less powerful than everyone else's. They were essentially buying that famous growth by taking a hit on their core profits. And here's what happens when you have a weak foundation. This is return on equity, or ROE. Think of it as the ultimate grade on a company's report card. For years, SVB was an A-plus student. But just look at what happened in 2022. It falls off a cliff. The whole high-growth story was officially over, even if the stock price hadn't quite gotten the memo yet. And it wasn't just one thing. The cracks were showing up all over the place. Unlike most healthy banks, they paid zero dividends to their shareholders. They were setting aside more and more money to cover bad loans, a clear sign they knew things were getting riskier. And that growth? A mind-boggling 271% in just 3 years. There's just no way their risk management could possibly keep up with that. So let's just recap, right? You've got this insane valuation, insiders are heading for the exits, and the core business is getting weaker by the day. A crash wasn't just a possibility at this point, it was inevitable, and it started way before the chaos of March 2023. And if you take away only one thing from this, let it be this. That famous bank run in 2023, that wasn't the cause of the collapse. It was the final domino to fall. The market was already waking up all through 2022. The stock lost over half its value as reality finally started to pierce through that story of perfection. The bubble was already bursting. So let's just walk through this one last time. Late 2021, we're at peak insanity, a valuation of 3.5 times its actual worth. Then, all through 2022, the wheels start coming off. The fundamentals tank, the insiders cash out, and the stock price gets crushed. The bank run in March 2023 was simply the final dramatic chapter to a story of decline that had been unfolding for over a year. At the end of the day, the story of Silicon Valley Bank is about a great narrative that completely overpowered the ugly numbers. Investors, the media, depositors, everyone bought the hype instead of reading the fine print. And that really leaves us with a critical question when we should all be asking ourselves, what's the perfect story that you're invested in right now? What narrative might be sitting in your own portfolio just waiting for its reality check?